Greetings and welcome to the Wealth for Real YouTube channel. I'm your host, Christopher Anastasio. Today is Wednesday, July 12th, 2023, and I'm going to talk to you about the thing you see on my screen right now. That's this working paper written by Raghuram Rajan called Has Financial Development Made the World Riskier? So I want to talk to you about this paper at a very high level because I'm not even done reading it. Let me just start off by saying that right away. I'm about halfway through it. But I couldn't wait to say something about it to you guys or get something out there to you guys about it. So I didn't want to kind of make that dependent on me finishing it. Super fascinating article. Let me give you some quick context. Found out about this article back on April 1st, I believe it was, when I watched Inside Job, the documentary from 2010 about the 2008 Great Recession, housing market crash, etc. In that movie, Rajan is interviewed, I believe, at one point. I don't think he has an extensive set of interviews in there, if I remember correctly. I think it was like one segment, maybe two. And maybe he was just referenced, but I think he appears at least once. And he and they in the movie talk about this paper that he wrote that was published in November of 2005. I bookmarked it back then, finally got around to reading it, 3 months later, and I'm not even done with it. You can see the website here, guys. I actually posted this on the Facebook page. You can pick it up right here. I just noted, I'm reading it. It's fascinating, blah, blah, blah. You can click this and you'll come here, and then you can come down here to download a PDF, and that will bring you here. Okay, so very, very quickly, guys, I just want to point out a couple things that jumped out at me about this. I really will have to do this justice at a different time when I've read the whole thing, when I've digested it, when I've thought about it, probably done some more research on some of the elements of it. It's not entirely 100% understandable to me the first time around, and maybe never. So I want to be perfectly honest with you guys about that. But let me just pop in on a couple things here. You can see Rajan wrote this paper in November 2005, published through the National Bureau of Economic Research. But in here, in the abstract, it appears that he's writing in his capacity from the International Monetary Fund, or the IMF, here in the Washington, D.C. area. In the abstract, you can kind of see what's going on here. He talks about, and you got to remember, guys, this thing comes out in November 2005. In 99, Glass-Steagall was basically repealed by the Gramm-Leach-Bliley Act. In 2000, the Commodity Futures Modernization Act deregulated derivatives. So by 2005, we're 5 or 6 years after that, and a guy like Rajan is kind of thinking about, I guess, the implications of that. So he's saying, I believe that's what he's referring to here. In the first half of this paper, he has not explicitly named those things, but we know as a backdrop, those things had occurred at that time frame. And so, excuse me. And so basically what we have here, and I just want to, hang on one second, guys. Just want to make sure. Okay, yeah, so just want to make sure I'm still with you guys on the recording. So basically, we know that those things had happened several years before this paper came out. And we know that they were creating sort of a framework of thought in terms of how the financial markets were being approached at that time, risk-wise, et cetera. And so I think that's got to be at least part of what he's referring to here when he says developments in the financial sector. There's probably more to it than that, but those were two pretty big things. One of them happening in 99. I forget when Gramm-Leach-Bliley passed in 99. Commodities futures was in very late 2000, in between President Clinton exiting and President Bush taking over. It was like December 21st, 2000, I think. But anyway, so he talks about developments in the financial sector has led to an expansion in its ability to spread risks. Increase in risk-bearing capacity of economies or in risk-taking has led to a range of financial transactions that hitherto were not possible. Now, strangely, he said this has made the world much better off. I think we've kind of found out that's not really true. But he does note here, we've seen the emergence of a whole range of intermediaries whose size and appetite for risk may expand over the cycle. Not only can they cause or accentuate real fluctuations, they can leave themselves exposed to small probability risks that their collective behavior makes more likely. Economies may be more exposed to financial sector-induced turmoil than in the past. That turned out to be true 3 years later. Paper discusses the implications for monetary policy prudential supervision. It suggests market-friendly policies that would reduce the incentive of intermediary managers to take excessive risk. And we know that they did. We know that this happened 2, 3, 4 years later as the market essentially exploded in the 07, 08, 09 timeframe. So that's kind of the setup there, guys. Now, he goes through a lot of stuff. Like I said, part of it understandable to me, part of it not. Examining risk behavior, what intermediaries do when they add risk to the equation, stuff like that. One of the things that started to kind of catch my interest specifically about this paper, because I'm such a fan of Nassim Taleb, and obviously his writings about Black Swan, Anti-Fragile, etc., was the common language, the use of the term tail risk, the use of the term blow up, which was just kind of a favorite colloquialism of Taleb's. So he uses the term blow up. Managers who take risk blow up. He talks about tail risk, and the thing that really kind of jumped at me as we kind of go through this, and I'll delay it for a second as you guys look at some of these sections here. Talks about different forces driving change, technology, deregulation. Obviously, this does discuss some of the deregulation stuff that I mentioned before, although it doesn't specifically call out Graham Leach, Bliley, or commodities futures there. It talks about disintermediation, how financial transactions have changed. Here you see a mention of credit default swaps. That obviously would come back to haunt everybody later on. Integration of markets, re-intermediation. Interesting chart here about ownership of corporate equities in the United States on the decline in terms of households and nonprofits holding those corporate equities. So he really kind of, role of banks here, really peels this thing apart in a super fascinating way, some of it over my head. But what really kind of jumped at me, guys, I'm going to go all the way down to page 20 here. I think I left off at 25, page 24, 25. So here he starts talking about hidden tail risk. And this is where he really is talking about things that Taleb talked about in the Black Swan and some of the other books that he wrote. Talks about peso or tail risk would produce a positive return most of the time as compensation for a rare, very negative return. Producing very high alphas, so managers have an incentive to load up on them. Every once in a while, they will blow up. True performance can only be estimated over a long period of time. So here he footnotes peso risk, and he talks about it here. Peso risk named after the strategy of investing in Mexican pesos while shorting the U.S. dollar. This produces a steady return amounting to the interest differential between the two countries, although shadowed by constant catastrophic risk of a devaluation. Another example, and here's the kicker, guys. Another example of a strategy producing such a pattern of returns is to short deep out-of-the-money S&P 500 put options. And as I reread this, I did not catch this the first time. I'm catching it real time with you guys. He talks about shorting deep out-of-the-money S&P 500 put options, which is the opposite when Taleb talks about in his book the barbell strategy of super, super conservative, like almost like cash under your mattress, and then super risky, where he talks about buying or going long on deep out-of-the-money S&P 500 put options. That means you're buying those put options and hoping that the S&P crashes. I notice here now on rereading this, Rajan is talking about shorting the put options, which is actually going long on the S&P 500, like thinking the S&P 500 will go up. And so he's saying that if you load these things up, you'll usually be correct. But then on that huge downturn in the S&P 500, you will blow up. And that makes perfect sense. Taleb, of course, advocates the opposite. He says, buy the S&P 500 put options. You will lose a little bit almost all the time. But on that one occasion that the S&P 500 tanks 50%, like it did in 2008, you will experience cubic gains. You will experience outsized gains. So it's interesting. I mean, they do take opposite viewpoints, or I don't want to say viewpoints. I don't think Rajan is necessarily espousing a viewpoint, but he's talking about how managers may seek alpha and they may do something like this strategy here. So I think he's making a factual observation, but he's talking about the one side of that transaction, and Taleb talks about the other side of that transaction. But this definitely harkened back for me, whether there was anything intentional in Taleb's writings, calling back to Rajan or anything like that. This reminded me of Taleb's writings, this whole strategy of using S&P 500 put options. Taleb talking about accumulating them and Rajan talking about shorting them. So anyway, guys, I just really wanted to use this video to call this paper to your attention. I think, you might make an argument, and I want to wrap this up here. You might make an argument, well, Chris, what does this have to do with anything? This is from November of 2005. It's 18 years ago. We already lived this. We already understand it. I don't think we do. I think we're getting ready for an even more epic blow up than 2008. I think it's going to be on a much grander scale. And I think at least some of the things that Rajan is talking about in this paper are going to show up again. The excessive risk, the disintermediation, the incentive to, to seek, outsized degrees of alpha, and then who cares if you blow up because somebody else is going to bail you out, type of thing. So I really think that's at play here all over again, but just worse. And so I think there are things to be, if not learned from Rajan, reminded of. Okay, where we would have forgotten about them, or I'm sure many of us have forgotten about them, who are in financial markets or invest for ourselves, or in the government or industry or whatever. Who's forgetting about it intentionally? Who's forgetting about it accidentally? The point is that this paper is a really good reminder of what our system has become in terms of how risky it can get and how people behave around that risk, particularly when they're improperly incentivized. And so I really think it's worth a look, guys, especially if you have the kind of interest level in something like Inside Job. I think you would absolutely eat this paper up. So check it out, guys. You can see it on the Facebook page. Like I said, I just posted it before I recorded this video. I would love to hear your comments, thoughts, ideas about it. If anybody has any other correlations between Rajan, Taleb, or anything like that, would love to hear it. But super, super appreciative of you guys checking out the channel, checking out the video, and would love to hear what you think about this paper. Hope everybody has a great Wednesday night, and we'll be here again with you guys soon. Thanks.